Hey guys, Christian here from Sanktuary. Today is the 23rd of September, and today's video we're going to do a little bit on Fibonacci and how you can use Fibonacci as part of your already established strategy to profit from the markets. Now, before we go in, just quick risk disclaimer: we're not financial advisors or have any qualifications of that sort. And if you want to find out more about that, you should get that information at your own accord. And so as it is. If you go on our website www.sanctuary.co.uk and scroll to the bottom of the page, we do have a risk disclaimer PDF there which you can have a full look at, and that kind of applies across all of our social media, including these YouTube videos, so I've made you aware there. Also, that we're doing a little introductory offer for new clients and our existing clients also. So if you open up a brand new account with us to have your capital managed today, we will be giving away a free cross pen set which is worth £75 retail. Contact us for some more information about that, guys, and it also applies to our existing clients. So if you top up an existing account, you'll be eligible for that as well. Quite low minimum investment levels there, but worth checking out. And some terms and conditions apply there. Okay, so basically Fibonacci, go to the chart here. We've got the dollar CAD on the 1 hour. And I'm going to basically outline what Fibonacci is. Now, Fibonacci is basically a sequence of key ratios of numbers. So basically, you might have seen the crustacean example where the shell, the swirls of a shell kind of line up in terms of certain ratios when kind of go into it in mathematical measurement terms. Now, it also applies to how a perfect face should look. So the most attractive face in the world will have the nose at the bottom of the nose at the 50% level, the mouth at the 61.8 retracement level, and the eyes at the 38.2 retracement level. Now, if you're not aware of Fibonacci, I do recommend just having a look at Wikipedia or Investopedia or anything like that regarding that. I will post a few links in the description below which are worthwhile having a look at. I haven't really had a chance to look them up myself at the moment, so I'll figure them out and I'll post them when this video goes live. Now, basically, if you're using TradingView, the Fibonacci tool is quite useful in the sense that it's got both retracement and extension levels. Now, these are the two tools that are used for trading primarily. There are some others. There's some spirals, circles, fans, all these sorts of things, but mainly I just use these two. Unfortunately, with TradingView, it's put on the same instrument for you to use there. So basically, if you had a move, say for example you had a bullish trend, you're looking to get in on that trend at a pullback. So these ratios can kind of outline areas of support there where the market could turn around and then continue on resume on its upward trend. It's kind of assumed that Fibonacci applies to all aspects of life, really. So is this? I'm not going to say it's the holy grail of trade or anything like that. There's no such thing, but it's one of those which actually helps and works very well for my style of trading. I like to use Fibonacci. It's used in more or less every trade I do. Some people don't find it useful at all. They don't find that they get an advantage. However, I like checking, because if you've got a distinct move and you're looking for a pullback, if, for example, on a bullish trend we're looking for that pullback, levels of support that you see on the chart already coincides with Fibonacci retracement level, and that's kind of going to add some kind of bias there. It's going to like a double check there for you to enter your trade. It's all about having those tick boxes, isn't it? So the major ones really are they're all kind of useful really, but I like using the 50 and the 618. 38.2 I don't know, it's one of those touch and goes really. I tend to find if it goes to the 38.2, you tend to sometimes just have a spike down quickly to the 50%. Obviously, the size of the retracement will dictate. So the larger the actual move that you're looking at, the wider the retracement levels are actually going to be. So in that sense, they work better on longer time frames. So if you're intradaily trading a penny stock, for example, it's worthless. There's no point using it at all. It's one of those where it's just you're gonna have price action which is gonna cut across two lines in one candle. It's just gonna look messy. So you've got to make sure that you do have a distinct line. So the best thing to do is kind of look at a swing low to swing high sort of move and use that also there. So some of these key levels also relate to our Fibonacci extension. The extension is where you can actually place your targets. So for example, if we had a market move to the upside and we had that retracement and we think, right, the trend's going to continue. So for the trend to continue, it's going to have to surpass the previous high. So let me draw an example here. So for example, if we've got this line here, the market moves up, it retraces, and we look to get in long at this level here. We would be thinking if the trend to continue, we have to get past this original high in order for the trend to be continuing. So the market pushes higher and goes above this level and continues on its upward trajectory. A Fibonacci extension tool can actually assist you in finding next targets by which to start looking to take profits or potential, these potential turning points in the market that the market might take. So you go up and you might see some slowing down there because obviously the market's ebbing and flowing all the time. That is kind of useful to have a look at. Now also, because you've got the extension, this original high that we've already illustrated is then a retracement level. So that's why I like using the Fibonacci retracement level. If the level coincides already, it might have previously been used like this with the extension tool previously to kind of gauge where the market stops now. So if the market retraced, we could look then for this sort of opportunity to start going long, so to speak, and then that way. So role reversal there, this resistance level now becomes support and kind of trend following. So let me just put an example up now on the actual dollar CAD so we can kind of see this in much more clearly. Now, there are a little bit of differences in how you draw them. So, for example, if we have a look here, we can see at the top of the wicks, this is the high we'd be looking at, really. I mean, I'm going to ignore that little bit extra. So, but then you've also got this tiny wick here, which is slightly below. So, if I draw a Fibonacci tool in, and I go to the top one, which I think is a bit more, you've got more bounces, it might be more significant, you can kind of see that the levels don't quite match up. So, the Fibonacci might have actually been worked better from this previous spike. So you can see here that the market has tried to make a retrace. It's retraced 38% because obviously these values you need to kind of flip them round. I've drawn it this way just to have the extension tool also. So for example, now we've got this move to the downside. The market's come back up and done a bit of a pullback. If we thought at this stage now the market, we might look for the opportunity to go short, thinking the market is going to target these new lows here at 130. We could then look at these values. Now I'd be, first of all, even though I just said that I'm not very keen on the 38%, if I get this price action whereby the market looks like it's starting to slow and rounding off, then I will of course take the opportunity. I just find that you get if you've got a trend following system, you're going to get more bang for your buck if the market starts to pull back further and has like a slow exhaustion of price action going higher. It's kind of that it's losing momentum right now. I'll get in. With these 38.2 retracements, you can kind of see that it can go sideways and keep going up, and I don't know, I just find it better. I can see it, you've got more to play with when you look at the 50 and the 61.8. So you can see here the market's come back up to this level here at the 38.2 level there at 130. 1.309, but it hasn't quite touched it properly. So if I draw it correctly, it's kind of a thick line. It does actually just miss. Now if we adjusted this line to this swing high here, presented by this large peak, this large spike upwards, it actually perfectly coincides. So maybe this actual, even though it's only slight difference, you might think it's negligible, it can actually make the difference in terms of how you're looking at it. So the market's come up, it's tested this 38.2 and it's starting to turn around. So if we could have been in a position where we could have put a limit order, an offer there to start selling the market, or alternatively at any of these different regions, or just entered at market if we were comfortable, and the market started to turn around. Now, if we believe that this 130 low is going to be broken, then the 127, the 138 and the 1618 are going to be certain levels that we're going to look for the market to kind of slow down its aggression, its move. Now, if we kind of look left for clues, we can usually gauge where we think the market's going to stop based on the kind of ratios. We can kind of see here we've got some previous resistance, which will now be support at the 127. So if I draw a line here, we can kind of see on the 127. Yes, and I'll draw them all in just to kind of have a little gander here, so we can kind of see there, and on the 1618. Okay, so basically what you can see here is if this low of 130 breaks, we'd be looking for the market to go lower, but we need to kind of, right, where are we going to look for profits to be taken? Now, this price action here, even though you do see different resistance levels, support levels and whatnot, it does look quite choppy. But having these ratios here can actually make you look left and kind of almost see what you might have actually missed, because obviously these levels are kind of bouncing nitty gritty, but when you actually line it up with the Fibonacci ratio, it kind of gives you a bit more of a understanding and kind of a more positive outlook, I find. So for example, now if I was short here now and the 130 level broke, I would be looking for 129.369 to start unloading these positions, or maybe a little bit higher, because you can kind of see the price action slightly above there. These ratios are not going to be perfect all the time. Now, it just so happens with this retracement it can sometimes be quite choppy in terms of, especially between the 50% and the 618, it can kind of be quite choppy, but you kind of need to just play around and have a little look there. So basically, yes, we'd be looking for the 127 to exit our position. Alternatively, if you're a counter trend sort of trader and you kind of think, right, okay, the market's moved down quite aggressively now, where would I be looking to go long for a relatively short-term opportunity, then you might be looking around the 127. The 138 and the 161 are the most the highest probability turning points. So they go up in stages. So the 1618 is the most probable area by which to see a turning point, and that kind of makes a bit sense here. As we just said, the 127, we got these small levels here, which are kind of little nicks really. You kind of see, the levels, even though it's holding, it's not a very distinct level, so to speak. It's quite subtle. You can see here it's kind of in and out, little nicks and crooks there. With 138 on this example, similar sort of thing. A bit more to it perhaps, but you can see the 1618 here, you've got a defined spike to the downside here, you've got another defined spike where the market did actually push well below that, but I believe it closed above. So yes, the market's pushed below this 1618 level. I have an advert now, and the market did push up by the end of the candle, so it shows that might be like a news sort of thing. Again, then we've got some price action here where the market's pushed below, retest, you think, oh, maybe the market's going down, it's kind of just double bottomed and come back up, so that's okay. But the 1618, it would be more probable here. But that's basically just an introduction to Fibonacci and how it can be of use to you. Of course, just like anything, they're not perfect. You could have a full retrace, although it's rare, you could have a full retracement of a previous move. So this move by here could actually just keep going up and up and try and target these previous highs, in which case there has been no turning point, so to speak, and there's no need to look at these Fibonacci extensions. So that's basically a quick overview. Again, if you haven't already, please have a look at our website where we do have that offer as well, and sign up to our monthly investment newsletter. It's quite good content there to kind of have a look at what we're doing, and just one email a month, that's all it'll be. So until next time, guys, thank you very much for your time, and sign out. Ta-ra.